flow of it. What is a pip? So I don't know why people get so crazy about what a pip is. It's probably one of the simplest things and probably one of the things that you'll least use, because pips are just used to calculate your stop loss and your take profit. More on that later in this video. So a pip is literally point in percentage. This is just to calculate the point in percentage of the currency. Whether it's Euro USD, GBP USD, USD JPY, whatever currency pair, this is just how you calculate the points within inside of it. So let's say you have the broker that is buying the currency pair for $1, they're selling it to you for 1.05, like the example we did previously. They use a pip to calculate that spread. What is a lot size in Forex? So this is actually something very key, because a lot of people tend to over trade using higher lots than they're supposed to. So make sure you pay attention. A lot size is basically what you're going to risk per trade that you take. A lot size is what's going to show you exactly how much you're going to make or how much you're going to lose. The bigger the lot size, the more you make, the more you lose. The smaller the lot size, the less you lose, the less you're obviously risking. There's websites out there like MyFXbook, position size calculator. There's many websites out there where it literally shows you how much you should risk, and it literally tells you the perfect lot size you should put on your trade so you don't over risk. I've been doing this for over 3 years, so I don't ever put my own lot size. So I just don't have to do the math. I just plug in my account size, how much I want to risk, what is my stop loss, how many pips is it, and then it literally throws me on my lot size, so I risk the amount of money that I want every single time. But basically what it is, they're just units that measure the trade and size that you refer to how much you're going to risk on the currency versus you're either going to buy or then sell. So make sure you use the right lot size so you don't blow your account or over risk. What is leverage in trading? So this is actually very important because it can be very dangerous. Because if you use too much leverage, you can either blow your account, but if you use it the right way, you can make a shit ton of money. So leverage is essentially borrowed money. So you're essentially borrowing money that isn't yours. So it's not like a credit. You don't have to pay this money back, or there's not a penalty if you use it. When you use leverage, is you're borrowing money from the broker or from the investors, whatever, so you can trade a larger lot size. So there's brokers out there that they let you trade with a 1 to 50 leverage, 1 to 100 leverage, 1 to 500, 1 to 1000 leverage, which is absolutely insane. I personally don't recommend anything more than a 1 to 100 leverage, because if you're using now money, or you're having now buying power of something that is 100 times of what your account is, you're prone to be able to risk so much more of your account that you can blow this much faster. So if you don't have that type of buying power, you're literally obligated, limiting yourself to not over risk. So if you have a small account, let's say anything from $100 to $200, I recommend going up to 1 to 200, 1 to 300 leverage, because you might need some buying power to be able to flip your account to 2, 3, 4, 5,000 pretty quick. But if you have anything over 5,000, I recommend you have at least, or at most, a 1 to 100 leverage, so you just don't put your money at risk. What is margin? So I'm sure you guys have seen the memes out there like, oh, I got a margin call because I blew my account. Yeah, that is basically what it is. So margin means that you're trading with leverage, which can increase the potential, obviously, of the returns, because you're essentially borrowing money. So the amount of margin is usually a percentage of the size of the position you're trading. So it obviously varies based off of the lot size you do. So margin is just the increased risk or return based off of the leverage you're using on the account. Different types of orders. So what are market orders? They're basically different ways you can enter the market. So there's 5 different ways you can enter the market. The first one being market execution, meaning get me into the market right now as soon as I click the buy button or as soon as I click the sell button. You want to get into the price as soon as you click the button, meaning you want to pay what the market is giving you that very second. This is probably what 80% of the traders use, and especially with my community or my strategy, because you enter right away. But you also have buy limit, sell limit, and then you also have buy stop and sell stop. A limit order is an order placed to either buy below the market or sell above the market at a certain price. This is an order that can either buy or sell the market once it reaches to a specific price for it. So they say you want to buy at the Euro USD at 1.5053. This is a buy limit. So in order for you to buy price, you need for price to get there. So you're waiting for price to get to that point in order for you to buy. So as soon as you put that buy limits, You just set and forget and you wait for the market to hit that order. So you don't have to actively be looking at the market. Same thing versus sell limit. You put a price where you want to sell price. So let's say you want to sell, once it breaks a support level and you want it to get you in, that's where you would place your limit order. What is a Forex broker? So basically the broker are gonna be the people that they execute the trade for you and that they make you the money essentially. Like they're basically waiting for you to take your trade. Once they take your trade, let's say you want to buy your USD, they get your money, they connect it to the markets. Once you decide to withdraw, they get the money from the banks and they take it right back to you. They make their money on the spread for doing that transaction. So they're basically saving you the headache of you calling into the trade or having to deal with the bank one-on-one and paying those extra super high fees, because it's just not possible for you to go to a bank directly. You have to go through the middleman, which is a broker, in order for your trades to get plugged in instantly and you get the best prices. So other than the broker, there's two other platforms you're gonna need to make money in trading, and they're super easy and super essential. That's gonna be TradingView, so you analyze your markets. So this is basically where you're gonna have your pairs, you're gonna do your markups, you're going to analyze your charts, whether you want to buy or sell, and then you're going to have MetaTrader, MT4 or MT5. This is where you're going to execute the trade that you analyzed on TradingView. If you want to download MT4, MT5, it's in the App Store. TradingView, you can just go on Google, and then the broker, again, it's in the link in the description below. So if you want to download MT4, MT5 on your Mac or your PC, the broker that I use in their website, they have like a thing or whatever where you can download it directly from them there. So you're going to need a broker, you're going to need a MT4, MT5, and then TradingView to fully analyze and take the trades in the markets. So now we have psychology. So psychology is overlooked by 99% of the beginner traders until they pass 1 year. After the beginner traders pass 1 year, they realize they can't learn anything else in the market because everything is pretty much the same. And once you have a strategy, now you just need to handle your emotions, your psychology. So psychology is overlooked by 99% of traders up to year one. After year one, 99% of traders just need to fix their psychology and not their technical work. As crazy as that might sound, that is almost as accurate as the stats are going to get, because psychology, it's all about yourself. You're the one that's going to decide whether you have FOMO, whether you have greed, whether you have very emotional type of trading, whether you're over trading, where you're everything at the end of the day is just you. So if you want to know about psychology, I highly suggest you guys go look at my podcast, or there's a bunch of series where I talk about that in this YouTube channel, where it teaches you how to have the proper mindset on trading. So I'm going to show you guys some real live trade examples. I took both of these trades in my Instagram, Telegram, Discord, like every single social media platform. I post this because I just do all of this for free to give back to you guys. Like I've said before, I want to be that guy that I wish that I had at the beginning of this very, very lonely and endless journey. So this trade right here is GBP USD. So like I mentioned earlier, if I'm buying GBP USD, this means that I am betting that the pound is getting strong.